Podcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Welcome to another CW webinar. I am Wanderson, and me and my team are here to discuss CW views on the pressing question: how will elevated freight rates impact the global shipping market? I would like to say that we would be a better timing to present this if we weren't seeing currently an historical day as we see the unfolding of a possible war in Europe. So this topic, for sure, it's a topic that has the most urgent uh, view today. So for starters, I would like to present myself. I am Wanderson Teixeira, business analyst at CW Group, based in Lisbon, Portugal. And also with me today, we'll have Prashant Singh, director at CW Group, based in Mumbai, India. In this page, you can find our contact details. So please feel free to reach out to us in case you have any questions or would like to get in touch to discuss any of our CW services. On today's agenda, we will start with an introduction of our company, what it is that we do, and how we can help you making informed business decisions, as well as a brief overview of the reports that we produced and also used to prepare this presentation. We have also prepared a macroeconomic overview and, of course, provide an analysis of the current and future state of rising sea freights. Please bear with me while I present our company. So CW is present across three distinct verticals: advisory, research, and media. Under the advisory, CW works with major consultants and leading institutions, including the World Bank, IFC, and sovereign wealth funds on consulting projects. We provide consulting and advisory expertise on a diverse product portfolio. And during this past couple of years where we have been seeing challenging times, we have helped multiple industry participants on their decision-making process. And this includes projects like a circular economy potential assessment across industries in Africa, where we provided a quantification of potential circular economy opportunity for around 20 markets. And we named initiatives, policies, and regulations that can support circular economy as well as its potential reduction of CO2 emissions. We also have worked on a cement market assessment in West Africa in collaboration with an important leading institution as part of our advisory scope. Now, under the research umbrella, CW focused on producing syndicated reports, and those reports cover areas like cement, building materials, coal, pet coke, bulk shipping, and also paper and pulp. We are well known for our studies on cement demand globally, as well as detailed industry and country reports. We also provide historical and forecasts for markets in a variety of products. This includes the volume forecast report, the trade prices report, and the white cement report, besides many others that we have. And we also provide commodity price assessments for both clinker and cement. Finally, under the media umbrella, by subscribing, we provide online access to our vast database. We also provided newsletters focused on cement, building materials, coal, pet coke, bulk shipping, and also paper and pulp with the latest industry news. And we are also returning to our in-person meetings currently, and we are, of course, very happy to announce our next conference, which is called Slag and Ash Trade 2022 edition, which is set to happen in May in Cologne, Germany, as well as other conferences that we have scheduled for the second half of the year. So if you want more details, please don't hesitate to contact us so we can get you informed. As I have previously mentioned, this presentation was prepared based on multiple CW projects, so we chose a couple of them to highlight today. To start off, we have the Global Cement Trade Price Report. This report is updated every quarter and covers gray cement, white cement, clinker, and granulated slag trade prices. This includes both imports and exports for the past year, as well as a forecast for the next quarter prices, and also covers domestic prices, meaning exports and retail prices. Second, we have the World Cement Clinker and Slag Sea-Based Trade Report. This report includes a detailed review of trade flows, pricing trends, trading infrastructures that are required to this specialized dry bulk cargo shipping sector, while also providing a comprehensive review of terminals, supply of cementitious materials, of course, to help support strategic decisions made not only by buyers but also sellers and shippers alike. And last but not least, we have the Global Dry Bulk Cargo Marketing Forecast Report, which covers international trade in tons for major and minor dry bulk commodities. We have interregional trade routes that are sized in tons, and we have a forecast for both major and minor commodities. Major commodities are further detailed in this report according to their grades, and we also have, in addition to this, insights on seasonality and bulker size and type. Now to continue, I'm going to pass the presentation to my colleague Prashant, so he can guide you through the global economic scenario.
Hello, everybody, and thank you for joining us today. In this section of the presentation, I will just walk you through the current macroeconomic environment that we find ourselves in. And as you see on the slide, the global economic growth prospects have actually entered slightly weaker than was the case just a couple of months ago. In these current times, this is not an uncommon occurrence where things are sort of changing not only by the day these days, but literally by the hour and minute. In addition to what we see, what is happening in the United States, where there is strong, sustained economic growth, we are seeing some financial troubles emerging out of the world's second largest economy, which is China, and in particular its real estate sector. And the banking industry, which has funded this real estate sector. So over the past few months, you've heard some news about some important real estate companies not being able to meet their debt commitments. And this is actually becoming more and more of a common occurrence rather than an exception. So the full impact of this has yet to be factored in, and this may turn out to be a much bigger impact on the Chinese economy than we have previously sort of understood and accepted. Now, according to the IMF's just January update just a month ago, global growth was supposed to slow down from 4.9%, which they predicted in October, to 4.4%. Now, given what has just currently happened, we are definitely going to see a sort of another revision. Major investment banks had already sort of started to cut their growth expectations for the U.S. in lieu of sort of rising inflation and the U.S. Federal Reserve's tapering policy. Maybe there were supposed to be 5 rate hikes that were supposed to be implemented this year prior to this invasion. Given what the, we don't quite know what the impact will be on energy prices, but it's safe to say that inflation in terms of the energy aspect is here to stay. Unfortunately, what we're seeing in Europe today is not the only geopolitical tension that we are encountering today. China is consistently, or has been consistently, showing display of force across the Taiwan Straits, and for now, that has limited itself to just displays. However, should that proceed to more concrete terms, could have even more consequential impact on global trade than what is happening today in Eastern Europe. Furthermore, you've already seen that in Yemen, we have the Houthi rebels who have been impacting and throwing, firing drones at Saudi Arabia and the UAE. And this is not likely to sort of calm down anytime soon. In addition, the Iranian nuclear peace talks are going on, and now with this invasion, we don't really know what the outcome of those talks, could be. And these are all factors that are going to have a major impact on how the global economy is able to persevere over the next few months and quarters. So if we go to the next slide, and of course, that is what you see on your news screens today, is the Russian invasion of Europe. For the first time since the Second World War, you are seeing a war on the European continent, something that most people thought that the specter of war was consigned to the history books, at least here. But President Putin has sort of now proven that to be wrong. The consequences of this, of course, will be far-reaching not only for Russia, Ukraine, but also for the wider world at large, as the economic sanctions, the disruptions to the global supply chain, and energy supply in particular, will impact growth. These impacts will continue to be analyzed in the coming weeks, months, and even years. As sort of already touched upon, we're seeing rising tensions in the Taiwan Straits. Just as the Russian invasion of Ukraine was happening today, simultaneously there was another foray into Taiwan's defensive airspace by the Chinese People's Liberation Army Air Force to sort of test their defenses. As for now, I think that China is sort of monitoring what is happening in Europe to test how the world will react, and see if they may not sort of take a more proactive action on Taiwan, which they have been threatening to do ever since President Xi Jinping has actually taken over in China. So what does this mean for the global economy? What does this mean in terms of inflation? On this next slide, where we have sort of tried to encapsulate what this means to, on a global level, you see that since developed economies in the second half of 2020 and emerging markets, especially since the second half of 2021, have rebounded, and inflation was and has remained a small but growing concern until a few months. But over the recent quarter, it has taken on a much more pronounced role, with all major central banks, especially led by the Federal Reserve, taking actions to sort of taper down inflation, with a prospect of inflation. Now, that being said, all major economies are now grappling with this challenge on how to control this, given that now we will see an intensification of crude and natural gas prices set to rise at least in the short to medium term. This is already going to present significant policy changes to not only central banks, but also governments as to how they approach, given that there are a lot of elections scheduled in the next year within major democracies. This could have a much more than larger impact than expected on sort of the outcome of political races. Unfortunately, the impact of rising energy prices has a cascading impact across the supply chain, and this will lead to rising food inflation and also impact, the less fortunate the most, especially in the emerging countries in Asia, Africa, and Latin America. On this next slide, we've tried to encapsulate for you sort of what is the expected forecast for the selected inflation in these major economies. Again, with the caveat that this was done prior to what has happened today, and those impacts have obviously not been factored in as of yet. But as you see on the bottom left-hand corner, already like energy inflation is a major driver of all inflation. And now this component is going to get even worse, not only in these major economies, but of course across major oil import or energy importing nations. And the expectation is that even what we are seeing today, even in the best case, it will take at least a year and a half for this scenario to sort of pare down in terms of inflation, and yet the inflation levels will still be higher than they were previously. So this is sort of, we're entering a new cycle where a higher level of inflation, given the sort of new macroeconomic and supply chain environment that we're in, is likely to be a consistent factor going forward. As you see, oil prices have already crossed the $100 mark today. Oil futures are rising even higher, and we possibly may see like higher peaks for European natural gas and Brent crude particularly than ever before. Hopefully, this will be a short-term spike, and if hostilities are sort of quickly resolved and a diplomatic way is found, the preceding months we should be able to see like prices come down. But we've now seen we've come to another elevated level where even after prices are down, they will still be much more elevated than they were previously to the conflict. On the next slide, I will sort of now pass this presentation off to Vanderson, who will take you through the heart of the analysis that we have done for this webinar. And I want to thank you all for your attention this morning so far. Vanderson, please continue.
Thank you, Prashant. Welcome back, everyone. To start the sea freight analysis, I'm going to start presenting you the global freight rate index, mostly known as the Baltic Dry Index. So as you can see in this chart, last year, at the end, basically of last year, we saw an upward trend in the Baltic Dry Index. Throughout the year, we saw an increase of 60%. That was most caused by shipping constraints, port congestions in China, and demand recovery for commodities globally. However, in the beginning of this year, the BDI saw a slight decline, and for the next quarters, we expect sustained demand from China's for commodities that combine with India demand for coal, especially from Indonesia. In addition to sustained demand from North America and Europe, are expected to further elevate these freight rates. In the short term, the impact of how my colleague Prashant mentioned, Russia's invasion of Ukraine is also expected to lead, or better said, could lead to higher bunker fuel rates, therefore also elevating the cost of cargo shipments. To be more specific, when we look at the Supramax and Panamax markets, we are starting to see a shift from traders. As you can see here in the graph, if you look closely, the BSI index, we can see that there's a higher growth when compared to the BSHI index. And this has been caused basically because traders are shifting, especially from Indonesian coal exporters, they're shifting from Panamax to Supramaxes. And this has been caused because there is a shortage of floating cranes in Indonesia's Kalimantan province. So we are clearly seeing a different performance in those two freight rates. Of course, we cannot talk about the global freight rate index without mentioning bunker prices. And as we are witnessing today, the Russian invasion to eastern Ukraine has taken bunker prices to an all-time high. If we can compare, for example, in 2018, a couple of months before the collapse of the Lehman Brothers and the global financial crisis started, we had the main shipping fuel, which was the IFO 380, reaching the average of $739 per ton. Today, the VLSFO prices, which is the low sulfur fuel, they are basically standing at similar rates. They are standing at $741 per ton. So we are seeing that prices have been climbing tremendously in the past couple of months, and especially today onwards, we are expected to see a further increase as a consequence of this invasion that is happening today. So in the next slide, we are going to talk about the container freight rate index. Here in this chart, you can see the global freight rate index and its trend from mid-2019 until earlier 2022, January. The container freight index has increased as a consequence of many factors, including China's zero COVID strategy, which is impacting economic activity, therefore leading to port congestions and delays, not only at the orange ports, but also into the destination ports. So to give you an example, when we have this congestion added to North American ports that are already crowded, we have a sustained increase in global container freights. Added to this, we also have shipping carriers that are charging premium fees or premium charges in order to avoid cargo being transported to those congested ports. So therefore, we have an additional cost being added to these rates. These charges, specifically in the east coast of US, can go up to $10,000 for container freight, in addition to the premium, meaning extra is being charged to ensure delivery to non-crowded ports. And these, for sure, exceeds by far charges from West Coast and European ports. Carriers in this case are also taking capacity from smaller routes to put in bigger routes, creating a shifting process, which has a result on freight rise, even in the smaller markets due to the lack of capacity. And therefore, we see that the container ship rates are expected to remain elevated because not only added to these additional costs from carriers, but also this shift on routes. We are also seeing that most of the vessels are expected to be taken to dry docks to refit the IMO regulations as we have for now. In this is next slide, we have selected a few ports around the US, China, and key selected countries in Europe. So we can see how has been this the current delayed days that these ports have been witnessing. As you can see, US ports have longer congestion delays for ships to come and unload when you compare mostly to European ports. Until late last year, these were more severe in the West Coast ports. However, we are seeing a shifting from ship owners to East Coast to avoid this issue. And therefore, this, of course, has a consequence of a longer unloading period in those East Coast ports. Added to this, we also have negotiations between the Pacific Maritime Association and the ILWU, which are expected to happen later this year. And this could even create a bigger impact on the congestion times in the West Coast ports if an agreement is not reached. And given the past history of those negotiations, we also have a little expectation that this will be resolved quickly and amicably between those two parties. So we have to see how the scenario will play in the short term. Also in this slide, you can see that we are showing 3 snapshots of ports on the West Coast. And we see that from January 18th to January 25th, we have a reduction in congestion time at these ports, taking to currently 66 ships waiting to unload its cargo on Los Angeles and Long Beach ports, which means that in the short term is unlikely we're unlikely to see quick fixes to this problem, as now we have not only West Coast ports facing this issue, we are also seeing a transition to also affect East Coast ports. In this slide, we can have an overview of the global trade deployment. We are showing here that freight between Asia to Europe and Asia to North America has been growing year on year significantly, more so in the case of North America, where we see an increase of around 33% when we compare it to last year. In North America, this is led basically by an economic recovery in the US, which has led to pre-pandemic levels of not only unemployment, also resulting in higher disposable income because people were working from home and there was less spending for travel and other related expenses, leading to more disposable incomes for purchase of goods. However, we can also see that economic growth prospects for Latin America are not so positive. This is due to macroeconomic scenario, but also political challenges the countries are facing. And this is resulting in a significant focus on commodity exports. To give you a better understanding of how this is affecting main companies' earnings, we have in this slide, we are showing shipping companies' earnings. And we see that container shipping lines, they are likely to this year to make an estimated $163 billion in operating profit, which will represent a growth of 8% year on year. And in 2021, we saw that carriers witness increasing profits And this was not necessarily due to higher volumes, but also because we had higher freight rates. For instance, we have some companies that did not carry more containers in the fourth Q of 2021 as they carried in the fourth Q of 2020. We have in the chart Maersk that reported a profit increase that was led not only by an increase in volumes, but also, as I affirmed earlier, by higher charging fees. And we also have other shipping companies that are reported that they are also seeing an increase in profits because, in addition to backlog at ports, there is also a shortage of containers. So with that, companies are willing to pay higher rates to get their products to the consumers. And because these rates are going to be passed on to the final consumer, the companies are not hesitating at all. To end our webinar, I would like to leave you with our closing remarks. Please don't hesitate to contact us if you have any further questions or clarifications. So to start off first, economic growth is still expected to be strong over the next 5 years, driven by a strong growth in Asia and the United States. Inflation is expected to stay at elevated levels due to various reasons. This includes geopolitical events, supply chain issues, and also demand growth. Container freight rates are also expected to remain at elevated levels on the Asia to North America routes, both the West and East Coast. As we saw, carriers companies are likely to continue to have a strong performance in 2022, and this is going to be due to sustained demand and ongoing port congestions. And last, reallocation of container capacity from smaller routes to more profitable Asia, US, Europe routes is also expected to remain throughout the year. I would like to thank you for joining us, and we'll see you in our next webinar.